All right, today is Wednesday, March 31st, and this is a post-market review for the stock market activities today, which by the way happens to be the end of the month and the end of the quarter, and therefore we're seeing some funny business going on throughout the week due to portfolio rebalancing. For example, the last few days we witnessed a certain theme of Treasury yields rising higher overnight due to overseas banks dumping bonds. But as we start trading here in the United States in the morning, we see yields retreating and bond prices rising higher. And the reason is due to pension funds and other financial institutions doing portfolio rebalancing right by the end of the quarter. And of course, they are buying bonds and therefore pushing yields lower. So you're seeing this back and forth between overseas bond holders who are dumping overnight, but that is quickly balanced and countered by pension funds buying bonds. Yet the imbalance is very clear because all in all, yields are managing to rise higher, and therefore the selling pressure on bonds is a lot stronger than the buying force from pension funds. In addition, portfolio rebalancing is over now. So if you continue to see the selling force from overseas bond holders, then the assumption is the bond prices will continue to dwindle, and as a result, Treasury yields will rise higher. The other thing we were watching for today is the unveiling of the infrastructure bill and how stocks will react in anticipation of the press conference by Joe Biden. The assumption was that infrastructure stocks will benefit and yields will rise higher due to inflation expectations, and that in turn will add downward pressure on technology and growth stocks. In the morning, we saw infrastructure stocks popping higher, but they were immediately sold off, and we actually saw the deflationary part of the market, specifically of tech, momentum, and high growth, catching a bid instead, even though Treasury yields remained elevated. So what is the take from today's activities? Number one, the portfolio rebalancing by pension funds and the likes is over now, meaning that the buying pressure that was countering the selling pressure in bonds is over. In addition, these fund managers are compensated based on their quarterly results, and they happen to own lots of technology and stay-at-home stocks exposure in their portfolios. We know that these stocks underperformed during the quarter, and therefore they gotta play some funny games in the market to make themselves look a little better by the end of the quarterly report. And in a short trading week, the path of least resistance is higher because you can push stocks higher easier due to low volume, and you saw the NASDAQ surging higher with low volume. So that leaves the big question: is the pop in the NASDAQ today sustainable or not? And what will portfolio managers do starting tomorrow, which will be the first day of the next quarter? Are they going to stick with what they've done today, or was it just a mere pump and dump to make themselves look a little better? And the other question is, how is the market dealing with the three main dynamics that are dictating its direction these days? The virus, oil prices / inflation, and Treasury yields. What new data is the market processing? I have all the information for you. We will try and answer these questions. Was the pop in the NASDAQ sustainable? What is the next move for portfolio managers? And the new information we have regarding market dynamics. But for now, I got a market to cover, and here we go. The Dow Industrial Average closing in the red, down 85.41 points, or a decline of 0.26%. The NASDAQ closing in the green by 201.48 points, or a gain of 1.54%. The S&P 500 closing in the green by 14.34 points, or a gain of 0.36%. And what about the sector's performance for the day? Leading the pack at number 1, capturing the gold medal, technology; at number 2 for the silver, healthcare; and at number 3 for the bronze, consumer cyclicals. Meanwhile, the laggards of the day led by financials, energy, and real estate. What about the futures market? We saw oil initially popping higher because the dollar did not surge higher again as we saw in yesterday's session. So what added pressure on crude oil prices by the end of the day? Number one, the news for more lockdowns over in Europe. We will discuss that during the Headlines of the Day segment. Number two, OPEC downgraded the demand outlook for 2021. These are the headwinds for crude oil today. We do have two tailwinds as well. Number one, the U.S. inventory was surprisingly down. Furthermore, we do have OPEC Plus with an announcement. I believe it's coming tomorrow. The expectations are that they will continue to restrict supply to push prices higher. We know that because of their outlook, downgrading the demand outlook for the remainder of the year. And what about softs futures? Lumber closing in the green again and above 1,000. Likewise, we do have gains for coffee futures. Meanwhile, we saw declines for both sugar and OJ futures. The action in cocoa and cotton futures was muted, closing pretty much flat. What about metals? We are anticipating a reversal to the downside for the US dollar, and metal prices, specifically gold, is a very reliable leading indicator for the movement in the US dollar. And today we saw gold surging higher, indicating that the US dollar is about to reverse lower. We saw gains across the board. Gold, silver, platinum, copper, palladium, all closing in the green. Likewise, when the US dollar is muted and expected to decline, we see gains for grains futures. Massive pops, soybeans over 5%, soybean meal over 6% gains in today's session alone. Soybean oil almost 5%, corn over 4.5% gains, wheat almost 3% gains, oats closing at almost 2.75% gains, and then we have canola closing a little over 4% gains for the day. The laggard of the day in grains futures, we have rough rice down just a little 0.5 percentage point. And while the so-called SPAC investors bragging about their gains, look at my SPAC gains. I urge you to look at my corn gains because I've been buying corn since last year and corn went impulsively higher. Corn is the new tech, bro. And of course, the rise in corn prices is adding to more inflation expectations. What about meats? Down day for feeder cattle and lean hogs futures. Meanwhile, modest gains for live cattle futures. Moving on to the big casino, the options market, and let's see what's going on here. The action as expected remains muted, but tomorrow will be the last day of trading, so there is an urgency for market participants who are left playing in the casino to roll the dice one last time before the end of the week, and therefore we're seeing a slight uptick in the options volume, just a slight one. Leading the pack at number one, Apple, by about 1.3 million contracts. About 70% of those were calls. At number two, Tesla, with about 725,000 contracts. About 66.5% of those were calls. And at number three, NIO, with about 550,000 contracts. About 65.5% of those were calls. And what about the unusual trades that took place in the options market today? How about we start with the ticker WBA for Walgreens. Walgreens reported earnings today, and somebody's fading the pop by buying the 50 puts, making a bearish bet with an expiration date of May 21st. With expectations that the name will decline over 9.5% by then, they paid about 85 cents apiece to enter this trade, bringing the total all the way to $900,000. What about the ticker TSM for Taiwan Semiconductors? If you have been a follower of this channel for a while, you know that I like TSM because it is one of those bullet stocks. What does that mean? It means that we have a semiconductor shortage, we have a chip war going on between Nvidia, AMD, Intel, Qualcomm, etc. And as legendary investor Peter Lynch says, when there is a war, you don't buy the stocks that are involved in the war. You buy the stocks that are making the bullets. In this case, for Taiwan, we don't care if there is a war between, say, AMD and Nvidia. That could add downward pressure on both stocks as they start cutting prices and competing against each other. But for Taiwan, it will manufacture the chips of both companies regardless. So it is the perfect bullet stock. And in this case, they are making a bullish bet buying the 126 calls expiration date, April 16th, with expectations that the name will climb over 6.5% by then. They paid about $1.30 a piece to enter this trade, bringing the total all the way to $1.3 million. And what about the ticker FCX, the first trade you see in the table, not the second one, even though both of them are bullish? Here's another name that I own in my portfolio, and it is one of my best investment decisions from last year because the name went impulsively higher since the March bottom, and we have a lot of tailwinds for the price of copper to rise significantly higher in the coming future. And therefore, somebody's making a bullish bet here for Freeport McMoran by buying the 39 calls expiration date June 18th, and they are expecting the name to rally over 18% by then. And they paid about $1.25 a piece to enter this trade, which brought the total all the way to $1.3 million. What about the trade for the ticker DHI, DR Horton? This is a home builder, and we know that the housing market is in a bubble territory, but it is hot and it gets hotter by the day. There is a massive demand and a shortage of supply, adding tailwind for these home builder stocks. Even though the rise in Treasury yields and interest rates in general, in this case mortgage rates, works as a headwind against these names because it cools off the mania in the housing bubble. But perhaps the current rise in Treasury yields and mortgage rates is not enough to pop the bubble yet. And in this case, they're making a bullish bet by buying the 105 calls, expiration date May 21st, with expectations that the name will rise over 17% by then. They paid about 70 cents a piece to enter this trade, bringing the total all the way to $470,000. What about the trade for the ticker XBI? And pay attention here. This is the biotech ETF. Biotech names get hammered with the rise of Treasury yields because the majority of the biotech companies are in the pre-revenue phase, so the valuations are based upon future earnings. The rise in interest rates and Treasury yields in this case dilutes the present value of future earnings, and therefore biotech names suffer under a regime of high interest rates. So in one hand, I view this trade as a bearish trade against biotech, but also a bullish trade for Treasury yields. In this case, they're buying the 126 puts expiration date May 21st, with expectations that the XBI will decline over 7.5% by then. They paid about $3.50 a piece to enter this trade, bringing the total all the way to $1.75 million. Continuing with interesting trades, what about the ticker ARKG? This is yet another ARK Invest ETF, and it is for the genomic revolution. Whatever that is. Knowing Cathie Wood, perhaps the Cheesecake Factory stock is within the Genomic Revolution ETF. You need diabetes patients first to do the genomic revolution. And is there a better place to develop diabetes beside the Cheesecake Factory? You see how smart we are? Everything is connected. Anyways, they are buying the 81 puts, making a bearish bet against the name, with the expiration date of May 21st, with expectations that the name will decline over 9% by then. They paid about $3.10 a piece to enter this trade, which brought the total all the way to $1 million. Moving on to the headlines that shaped the day, starting with macro news. What about the housing bubble? Prices are surging significantly higher. Meanwhile, wages are struggling to keep up with the rise in housing prices. The last time we saw this phenomena was during the buildup of the housing bubble that bursted in 08-09. What could go wrong this time around? The Federal Reserve doesn't see inflation anywhere and believes that more inflation will actually help the disadvantaged, the poor, and the middle class. Ask yourself a question. Looking at this chart, is higher inflation really helps the poor and the middle class, making housing inaccessible, creating a homelessness crisis in the country, and the housing mania is getting hotter and hotter by the day. Pending home sales fall sharply as supply hits a record low. The number of contracts signed to purchase a home in February tumbled 10.6% from January. Pending sales were down half a percentage point year over year, and therefore you're seeing all of these cash offers piling up for existing listings. If you are selling your house right now, it is a golden opportunity because they are stampeding to buy the house. Cash offers. While it's wide open, are you gonna take it? Are you man enough to take it? Fixer-upper, no problem. Water leaks, mold, no problem. A double homicide/suicide took place in the house, no problem. Ghosts from the Civil War era haunting the house, no problem. Here is my cash. You know why? Because there are no more homes hitting the market. There were 1.03 million homes for sale at the end of February, down 29.5% year over year. That is the largest annual decline in history, the lowest supply ever recorded, the biggest housing mania ever. Again, what could go wrong here? We are talking about 2008 as if it was ancient history, for God's sake. We haven't learned anything, and it's about to get even worse. Because if home buyers realize that we have bottomed in rates and mortgage rates will continue to climb higher from this point on, that will encourage them to stampede even harder to buy the current supply available in the market right now. So if you are sitting on a piece of junk house and you know it is a piece of junk, it'll be stupid not to sell your house right now. It's a mania. You'll never find a better opportunity than this one. They are stampeding with all cash offers. You dump your piece of shit house, you move to a rental, and when this whole mania comes down crashing, the bubble pops and housing prices crash, you will have the upper hand. Perhaps you can buy your home back. You know that piece of shit house that you just sold? You can buy it back for a cheaper price. Because here is the current rise in Treasury yields, specifically the 10-year, and it is the fastest rally in history, only preceded by the 1994 run. And we know that in 1994, the sudden rise in Treasury yields resulted in blowing up many funds that were highly leveraged. Now, you are aware that we just saw one happening here this weekend. In 2021, the Archegos Capital blow-up. Therefore, there are many more to come if yields continue to rise higher. Furthermore, in 1994, we saw the blow-up of the Mexican pesos and the so-called tequila crisis. So the question is, if we continue in this trajectory, it's not just going to be funds, but even countries are going to blow up. And notice here that the other three instances when yields surged to this magnitude before were 2013, when we saw the famous taper tantrum, and the year 1999, preceding the burst of the dot-com bubble. Not a good company to be with. And why are Treasury yields rising impulsively higher? The answer is inflation expectations. So are we doing better or worse in inflation expectations? Here is the answer from different Fed districts. Whether we're talking about Dallas, Kansas, New York, the prices paid versus prices received in their surveys have one of the widest gaps in history, and prices paid reached historical highs, meaning that the input prices for manufacturers and producers are surging significantly higher. And of course, they will pass the extra cost in inputs to you and I, the end customer. But these are just 3 Fed districts. Perhaps other districts are doing a little better. Let's see. What about Philadelphia and Richmond? Even worse. The prices paid in both Philly and Richmond reach historical highs, higher than the 08 highs. I know, but there is no inflation. Where is inflation? I can't see it. And here is the entire picture when you combine the results from all of the Federal Reserve's districts. Prices paid in red this time, pretty much at all-time highs, far exceeding the prices received. Once again, inflation is here. It is not imaginary, it's not coming, it's already here. All you have to do is to take your blindfolds off. If you do take your blindfolds off, you will see the mania happening everywhere, not just in the housing market, but also in auto sales. Here's the headline. The U.S. car market is surging ahead as people prepare for the return of commuting in some sense to normalcy. And in this case, customers are willing to pay cash for the car above the asking price, even if it is the wrong color. Sir, we are sorry. We know that you ordered the ruby red, but we only have the onyx black. No problem, I'll take it. And the other thing, sir, is the air conditioning doesn't work yet in the car. No problem, I'll use a fan. Oh, and another thing, sir, the car doesn't come with an engine. No problem, I'll just use my feet like the Flintstones. Absolute mania. Of course, they're gonna run out of new cars pretty soon, and the value of your beater used car will appreciate significantly. And therefore, if you have a used car, maintain that thing. Change the oil, make it look nice and clean, because you might have to sell it soon if you're not using it, because it will be worth a fortune in this mania. And of course, the main event of the day was the unveiling of the so-called infrastructure bill from the Joe Biden administration, aka the BlackRock administration. And here are the details for this bill. $621 billion for transportation infrastructure, $400 billion for care for elderly and disabled Americans. How is that infrastructure? Anyways, $580 billion for manufacturing, R&D, and job training. And this bill mentions specific industries by name. For example, the semiconductor industry. President Biden is urging $50 billion infusion for U.S. semiconductor industry amid a global chip shortage and tech gains by China. Furthermore, the bill adds 500,000 charging stations for EVs nationwide. And right away, you saw EV stocks exploding higher. In addition to the speculative names in this arena, Blink Charging, Plug Power, Fuel Cell, etc. These happen to be the retail's crowd favorite names, and they managed to pop higher today because they were beaten down significantly for weeks and weeks now. So we saw a massive orgasm in certain sectors of the market, namely the semiconductor sector and the EV/solar/ESG sector. But the truth is that this so-called infrastructure bill is a part of a $4 trillion Rebuilding America bill. And while it is dubbed as infrastructure bill, there's a lot of waste and woke initiatives within this bill. For example, Biden aims to narrow racial inequities as part of his infrastructure and jobs programs. We know that a lot of that money will go into the pockets of contractors on Wall Street. We also know that a spending bill of this magnitude will add to inflation expectations and the inflation of prices in the economy. We're already seeing it in automobiles, housing, food, raw materials, gas, and other items. Ask yourself a question. Does increasing inflation and making housing inaccessible to the poor and the middle class will help with racial inequities, will help the poor and the middle class? And right away, we have Mitch McConnell coming out of his shell and opposing the bill right away. McConnell calls Biden $2 trillion infrastructure plan a quote-unquote Trojan horse, slamming tax hikes. Of course, McConnell had no problems when the Trump administration, aka the Goldman Sachs administration, passed trillions and trillions and trillions of dollars of spending that went to waste as well. But last time around, we were paying by that with more printing. In the Biden plan, of course, we're paying with printing, but it comes hand in hand with increasing taxes. Of course, we can disagree that, hey, taxing the rich alone is not going to make it. He says he can raise $1 trillion in 15 years from taxing the rich, but the bill will add $4 trillion. The price tag is $4 trillion. So raising $1 trillion from the rich in 15 years is not going to pay for it. So how are we going to pay for the rest of the bill, the $3 trillion and the other trillions from previous bills? The answer is more printing and more taxes. This time around, not just on the rich, but also on the poor and the middle class specifically. And of course, it appears that the Biden administration and the Federal Reserve are embracing MMT, modern monetary theory, which states that adding more to the debt doesn't matter because you can print an unlimited amount of money, and therefore you should print to oblivion and use that money to fix all of the social, environmental, and other problems in this country. What they are not factoring, though, is that printing unlimited amount of money, adding more to the debt, and more to budget deficits will add and create more inflation. How does inflation help the poor and the middle class? MMT ignores the fact that printing money and monetizing debt, even when that debt was partially demonetized in local currency, led to devastating inflation in Austria, Hungary, Poland, and Weimar Germany during the first half of the 20th century. And here is an example from a donkey economist who says unexpected temporary rise in inflation poses little risk, but leaving 10 million workers on the sidelines leaves lasting damage. Let's remember the dual mandate is price stability and full employment. Yes, price stability, as in not creating price distortion by more inflation, you think? And she says unexpected temporary rise in inflation. Unexpected? Really? It was expected. We've been talking about it over and over and over again, warning and warning and warning. And how do you guarantee that it is temporary? Oh, but I know it is just transitory. And if it's not transitory, we got the tools, bro. And here is the other thing. How do you suppose that more spending and adding to the debt will help recover the 10 million lost jobs that you reference in your tweet? We know that recovering these jobs is not a matter of spending more money. The jobs are here, but the virus is the factor dictating the recovery of these jobs. The lockdowns are the reason behind losing these jobs. The majority of these jobs are in the leisure, hospitality, and travel sectors, meaning that recovering these jobs depends on defeating the virus, not issuing more spending bills. And lastly, just to add one more jab, how does inflation, even if it is temporary as you say, and assume, how would it help and benefit the unfortunate, the disadvantaged, and the unemployed? And here we have Sven Hinrich with an excellent response. Then why did you cut rates 3 times in 2019 when unemployment was at 3.5% and prices were stable if that is your mandate? There you go. If you say, hey, price stability and full employment is our mandate, then why didn't you increase rates in 2019 when we had full employment? The answer is because their mandate, the Federal Reserve that is not price stability or employment. The real mandate is to prop up, inflate, and protect the assets of the wealthy, stocks and real estate. That's their main mandate, not to help the poor and the middle class. Otherwise, they would have increased rates in 2019. Instead, they cut rates. You know why? Because Wall Street and the stock market threw a fit. The market is, say it with me, a cocaine addict. The market cares not about pandemics, civil wars, nuclear wars, asteroids. That doesn't matter. What matters is the flow of cocaine. What is the cocaine? Fiscal and monetary liquidity. And in 2018, when the Federal Reserve hiked interest rates, the stock market crashed, even though we are amidst one of the hottest economies we ever had. And the reason is the market cares not about how hot the economy is. So those who are expecting the upcoming hot economy and hot recovery to reflect in the stock market, either you are a hypocrite or stupid, or perhaps both, because the market doesn't care about good news economically. It cares about the flow of cocaine. And good economic news mean that the flow of cocaine will be interrupted, and therefore the market in this case will suffer a withdrawal. Good news is the market's worst enemy right now. And by the way, if you are expecting the stock market to surge higher because the economy is about to be very hot, then shouldn't the stock market traded down last year when the economy was in shambles? Oh, it doesn't work that way. I know. Last year, yes, the economy was in shambles, but the market looks forward, bro. Twist and turn the rules all you want to accommodate your bias. Here's another consequence for this freak show, by the way, the collapse of the US currency. All of this printing will dilute the value of the US dollar. The dollar's share of global currency reserves dropped to its lowest level in 25 years. The slide came in a quarter when a gauge of the greenback fell the most since 2010, and amid questions about how long the dollar can maintain its status as the preeminent reserve currency. The Chinese renminbi is transforming into a force to be reckoned with in the currency market, with more yuan changing hands than ever before in London, the world's leading foreign exchange center. And the last bit of news we have in the macro segment are regarding COVID-19, because the rise of COVID-19 infections will perhaps tamper those inflation expectations if it leads to more lockdowns or delaying reopenings. For now, we're not doing that here in the United States. But here it is. New COVID-19 cases are on the rise in New York, a day after the state expanded vaccine eligibility. The state's 7-day average fell below 5,000 cases last Tuesday, but new cases in the past week have risen to an average of nearly 11,000, more than doubling the rate in the prior week. So we continue to monitor the situation. I doubt that we will lock down because these governors, Cuomo and Newsom, are in big trouble in their respective states. But here's what's going on across the ocean. French President Macron announced a nationwide 4-week lockdown. And as soon as this headline hit, you saw the decline in crude oil prices. So back to the market dynamics. This is what the market has to process every single day. The information under each category, whether that qualifies to unlock the door for the next step or not, because they're all intertwined and correlated. Bad news regarding the virus will mean that we cannot unlock the door for higher inflation, higher oil prices, and therefore higher Treasury yields. And that is good for the NASDAQ. And therefore, I keep saying the NASDAQ bulls have an ally in COVID-19. Moving on to market sentiment news. With the infrastructure bill and all of that, everybody wants to know how to play the infrastructure spending tsunami that's about to come. Here's from Forbes. These are the sectors that would benefit from Joe Biden's massive plan to fix roads, bridges, ports. John, whatever the hell that is, chief investment strategist at whatever, told Forbes that such a broad plan will benefit a multitude of companies in various industries, including information technology, industrials, materials, and energy. Within the industrial sector, whatever that is, points to manufacturers of road graders, cranes, power generators, bulldozers, dump trucks, flatbed and enclosed trailers, pickup trucks, SUVs, and RVs. Okay, is he gonna give us stickers or what? Because we are zombies high on meth. We're looking for tickers. We want tickers. We want tickers. We want tickers. Makers of construction materials of all kinds, including asphalt, concrete, steel, aluminum, and copper, will find many opportunities under the plan. Okay, this guy's not going to give tickers, so I'm going to stop reading here. The $174 billion to be set aside for the electric vehicle market would obviously favor EV manufacturers and electric battery makers. But that would be slightly longer-term play, given that Biden plans to form a network of 500,000 EV charging stations by the year 2030. Okay, this guy's not going to give tickers, so we're moving on. Give me tickers or give me death. Here's a survey of market participants, asking them what is the inflection pain point where you think the market will face a problem. They gave the rate of above 3% inflation. That would be a problem. According to those surveyed, if inflation rises above 3%, and by inflation they're talking about the PCE garbage formula. If it rises over 3%, then we have a problem. Well, the Federal Reserve says 2%. We might overshoot to 3%. We know if the CPLI or the piece of shit PCE says 2%, 3%, that actually means north of 5% actual inflation. What about the 21st century's tulip mania? I got some good news for you, cryptomaniacs. Goldman Sachs will reportedly soon offer its private wealth management clients avenues to invest in Bitcoin and other digital currencies. Perhaps they can pull the same magic trick they did with Bill Wong and Viacom in the crypto market. Now, what about the SEC? Speaking of Bill Wong and Viacom, Archegos, the SEC waking up from its coma. And by waking up, we mean opening one eye slightly and then going back to sleep. The SEC has opened a preliminary investigation into Bill Wang over his leverage trades that have roiled Wall Street. We opened a preliminary investigation. We're looking into the matter. Moving on to corporate-specific news, starting with, you guessed it, the souffle, Tesla. And we have good news for the souffle. Can you believe that? All of you who accuse me of being a Debbie Downer, anti-souffle, well, here it is. I am pro-souffle today. 79% of all EVs registered in the United States last year were souffles. At number 1, Model 3 with over 95,000 registrations. At number 2, the Model Y, also from the souffle. At number 3, the Chevy Bolt EV. And you see that Tesla dominates the EV market in the United States. Here's the problem. We have new competitors about to enter the chat. Will Tesla maintain its dominance amidst the competition? And most importantly, will the market continue to excuse the insane valuation of Tesla, given the fact that this is perhaps the peak for Tesla's dominance in the US market? They already lost their dominance in China and the EU markets. So I guess we don't have good news for the souffle after all. I mean, it is April Fool's, isn't it? Anyways, what about VW? VW had to apologize for misleading customers and investors after releasing an apparent April Fool's joke in March. The company said it was rebranding its US arm to Volkswagen in an effort to promote its new electric vehicles. And now they're saying, oh, we're sorry, we made a bad joke, don't take us seriously. I mean, it's a German company. After all, never mind, I'm just kidding. I don't want to offend my new German viewers. We have been experiencing high audience growth in Germany. Moving on to the flying coffin. Boeing. Boeing CEO says virus transmission is not a threat on an airplane. You know all of these doctors over at Boeing? Moving on to the iMob. Apple. New iPhone 3 exclusive reveals stunning Apple design decisions. And spoiler alert, the iPhone 13 looks exactly as the iPhone 12. Matter of fact, it is the iPhone 12. We just added new skins, which will cost you an additional $200 from the previous model. New colors, optimism. Should we add another trillion for Apple's valuations? You know, for the upcoming super thing. And what about Robinhood? You know, Robinhood is about to do the IPO. Perhaps a little Johnny-come-lately here. But they've been accused of gamifications, making the stock market into a mockery. Robinhood is getting rid of the confetti animation that appears on user screens after they conduct their first trade and achieve other milestones. Ta-da! You just lost everything. Here are some cute animations for you. And lastly, in corporate news, what about Microsoft? Microsoft has won a contract to build more than 120,000 custom HoloLens augmented reality headsets for the U.S. Army. The contract could be worth up to $21.88 billion over 10 years. Of course, you remember a few days ago in our options market coverage, I showed you a trade for Microsoft exceeding over $1 million. You think that was a coincidence? Or did they know about this contract? Nothing happens as a coincidence in the options market, specifically for these massive trades. Moving on to the heat map analysis, and let's see what happened today. Right away, you're seeing profit taking from the so-called inflationary trade of financials, energy, industrials, materials, defensives, and rotating some of that money to buy the dip in the beaten down technology and mania names. The likes of Tesla, Carvana, Neo, Zillow, Airbnb, Snapchat gaining over 5% today. The stay-at-home names, Peloton was up, Zoom was up, the software names were up. We also saw chips catching a bid with two tailwinds, the Biden administration's announcements and the rotation to buy the dip in these technology and beaten up mania names. We also saw big technology names outperforming today, whether we're talking about Apple, Amazon, Facebook, Google, Microsoft, all closing in the green. The big question remains, Is this sustainable? Is it a one-day wonder? Or are we legitimately rotating to buy the beaten down technology and high valuation names? Or is what happened today just a mere April's Fool's joke? Meaning, did the pension funds and the likes pump up the beaten down positions to look a little better by the end of the quarter? Meaning a pump and dump, and then they rotate back to the inflationary trade? That remains to be seen. What we know is that the macro reasons for fund managers to start rotating from the high growth, high tech sector to the so-called inflationary trade, value names, financials, energy, industrials, etc. These macro reasons did not change, chiefly the rise of Treasury yields. Today, we saw Treasury yields surging higher, yet the NASDAQ surged higher. One of these two is a false move. One of these two is lying. Which one do you think is lying? A, the rise in the NASDAQ today. B, the rise in Treasury yields today. Let me know in the comments. And what about the themes for the market today, starting with the reopening names? Declines across the board, not anything major, modest declines, just a little bit of profit taking. But this trade remains hot. The risk for this trade, of course, is more lockdowns and delays of reopenings. We're not there yet, at least in the United States. What about the inflationary trade? All in all, a negative picture, even though modest losses for most names. So which trade caught a bid today? The answer is the deflationary trade, specifically tech and high growth. Big gains across the board, whether we're talking about Snapchat, Zoom, Okta, Nvidia, Square, Shopify, Peloton, Tesla, DocuSign, ServiceNow, all with massive gains today. The question remains again, can you trust these moves that we saw in the market today, given the fact of portfolio rebalancing and the low volume overall? Moves usually don't get confirmed with low volume. Moving on to the charts analysis, starting with the SPY 15 minutes chart. Remember that we still have a gap open at 395.63 that hasn't been closed yet. Today we gapped higher, leaving that gap open and opening yet another gap. So we have two gaps open here, 395.63, and here is the other gap at 394.79. This is the gap that was opened from today's activities. When you have two gaps open, that's not a good setup, and you are likely to go down to close at least one of these two gaps. Moving on to the daily chart of the continuous contract of the S&P 500. We talked about the very important level, 3,960. Today we closed at 3,964.25. Slightly above the number. Is it a solid closing? Of course not. We need to see a weekly closing above 3,960, and that would be a solid confirmation that the bull flag consolidation that you see in the screen right now will indeed play to the upside once and for all, breaking above 3,960. Now, what about the weekly perspective? We have to talk about this to give you the full picture, short term, long term, because switching between the two time frames changes a lot of things. For example, here is the weekly chart of the SPX, the cash index. We do have that resistance line, the yellow trend line that you see acting as resistance for the SPX going all the way back to 2019. We are in a wedge consolidation that is usually broken to the downside, not the upside. Wedge consolidations break either way. But in this case, this rising wedge consolidation usually breaks to the downside. But we know what that would mean. Because the SPY, the S&P 500, is a wholesome index. It includes technology, energy, financials, materials, industrials, everything. So it won't go down if only one sector gets shot. Meanwhile, the other sectors outperform. Meaning, if technology gets shot again, meanwhile, the inflationary trade manages to outperform, then the SPY will continue to rise higher. So if you are subscribing to this rising wedge pattern and that it will break out to the downside, then you are betting that pretty much every sector of the market will get shot. The inflationary trade, the deflationary trade, technology, momentum, growth, it doesn't matter. You're betting that the entire market is going to go down. Is this what's about to happen? You see the conflict between the daily chart for the continuous contract showing a bull flag consolidation that could break to the upside, surpassing the resistance level of 3,960. But the weekly picture says, not so fast, because we have a rising wedge that will break to the downside. What about the Qs? 15 minutes perspective. We have a similar story here with the SPY. Remember that we left a gap open at 315.46, and today we opened yet another gap. And you know that the center of gravity in this chart is 313. And 313 happens to be very possessive of the chart. It doesn't like when the chart gaps higher. Case in point, we saw these pops higher, gapping higher many times before during the last few weeks. I'm highlighting some of these pops. Everybody assuming that the NASDAQ is out of the woods, we're about to rally, only to be surprised by the gravity of 313 going down to close all of these gaps and recheck 313 for support. If past patterns are true, then this pop we saw in the NASDAQ today will indeed reverse to the downside. Let's talk about the daily chart for the continuous contract of the Qs. We talked about the reverse head and shoulder formation as a possibility remains on the table so long as the chart doesn't break the support of 12,766. Once we close below 12,766 from a daily chart's perspective, then that would trigger a sell signal for the NASDAQ. For now, we don't have that sell signal. Even though I jumped the gun already, and I bought some SQs calls a few days ago in anticipation of unveiling the Biden infrastructure plan because it will increase Treasury yields and in turn, rationally, the NASDAQ should go lower. But today, due to the portfolio rebalancing, we saw the NASDAQ popping higher, not lower. And therefore, those calls for the SQs are scrambled eggs. But if we do indeed close from a daily perspective below 12,766 in the NASDAQ futures, I will open a new position betting against the NASDAQ by buying calls for the SQQs. Sometimes you have to wait for the confirmation technically before you jump the gun. Moving on to the IWM 15 minutes chart. We talked about closing above the double top pattern. That would remove the bearish outlook that the Russell 2000 has lower prices to visit at least in the immediate term. We did see that, but we also gapped higher, slightly above the support line of 218. And the assumption is that we have to go down, close the gap, and revisit the support of 218, and then bounce higher again. That would be the bullish scenario. But breaking below 218, turning it back into resistance, will mean that the IWM has lower prices to go. And the bounce we saw the last few days is a mere dead cat bounce. Zooming out to the daily picture of the RUT, the Russell 2000, do we have a breakage of the trend of higher highs and higher lows? Not yet. Perhaps we're seeing a bear flag consolidation that will lead us to break the trend, form a lower high? Perhaps, but for now, we don't have it. For now, the trend remains intact. What about the Dixie? The Dixie closing above 93. It is consolidating in that level. We are anticipating a reversal in the US dollar. We just announced $2 trillion worth of spending. We have another $2 trillion that will be announced shortly. The bet is that the US dollar will reverse because the current bounce higher was due to foreign buyers moving to the safety, quote unquote safety, of the US dollar during the bond sell-off. But we will have other options to park that cash in beside the US dollar in the second quarter. So we are anticipating a reversal in the US dollar. This is at least what gold is saying because we know that gold is the Mr. Mature guy in the room. It doesn't make an impulsive move up or down unless it is calling something with 100% confidence. It's a canary in the coal mine, a very decent leading indicator. In this case, as you saw in the dollar index chart, the dollar did not move significantly up or down. It was muted today, yet gold had a massive pop from the Fibonacci level support, indicating that perhaps we will see the dollar index reversing very soon. Of course, we need a confirmation in this pop in gold before we make the call. And that confirmation must come as soon as tomorrow. And by the way, here it is. The gold slump in 2020 year to date is the second worst since 1982. But take a look at what happened in 1982. Gold slid down all the way to 19.5% down during the first quarter of the year. And then it started to recover and it finished the year with gains over 10%. So patience is a virtue here if you are a gold bug, but it's not going to be an easy ride to be in. What about the Bitcoin bugs? What's going on here? Moving according to plan, we do have a potential crossing in the MACD indicator and fixing the negative divergence in the RSI, meaning that if that happens, we have another massive pop higher, another leg higher in Bitcoin. What you gotta watch out for though is the following: breaking the series of higher highs and higher lows, meaning that if we reverse tomorrow, closing the week down, that will qualify as a lower high, thus breaking the trend. You don't want to see that if you are bullish Bitcoin. What about the TNX, or in this case, the 10-year Treasury yield? According to plan, higher highs, higher lows, the trend is intact, and the assumption is that we have higher readings in yields to come until and unless we break the trend. What does that mean for the TLT bond prices? Not doing so hot so today, closing in the red, consolidating in what appears to be a bear flag formation. And once again, if we close the week below 134.5, that will indeed trigger a sell signal for the TLT. What about the VIX? Still hanging around, battling over and over and over again the resistance of 20. It doesn't want to close below it. It doesn't want to have a flush down, but it is fighting it very hard to rally from this point on, so long as the inflationary trade of financials, energy, industrials, materials, defensives remain in favor. Because how would the SPY trade lower without these sectors of the market reversing? We might have a reversal for whatever reason coming up, but for now, we don't have any trigger that we can see clearly. But it is amazing that the VIX is still hanging around at these levels, because let's be honest, if we are anticipating the market to rally, whether it is the inflationary trade, the deflationary trade, whatever camp you're in, if you are expecting the market to rally, the S&P 500 to go higher, break above 3,960 once and for all, then the VIX should be a lot lower. So the resilience in the VIX remains very notable. We are watching a positive crossing in the VIX any minute now. Any pop higher will confirm an upcoming momentum, at least from the MACD indicator's perspective. And what about the big kahuna, Apple? Here's the chart from a 15 minutes perspective. The center of gravity remains 120, pulling the chart lower. And the chart did something it shouldn't have done, which is gapping higher above the center of gravity. That's not good, because you're going to have to go down and close these gaps. We have two of them now. Gap number one at 121.37. Gap number two that we opened today at around 120. 120 also happens to be the center of gravity. So don't be surprised if you see Apple going all the way back to 120. The challenge is, if you are bullish Apple, you don't want to see a closing from a weekly perspective below 120, because that would be a confirmation that we have lower prices to come for Apple and the NASDAQ as a whole in April. What about Tesla, the souffle? The souffle is having a decent day. Thank you to Uncle Joe, because he is including a massive EV spending in the infrastructure plan. And I was just watching the conference a few hours ago, and Biden said that he will restore the federal tax credit for buying electric vehicles. So now Tesla has tailwinds to do what? To close above 679. It's not too far from here, but you gotta close over 679 for this guy you're listening to right now to start buying calls. Otherwise, the bearishness will remain dominant. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? Number one, per usual, we have the weekly jobless claims. We do have the very important ISM and manufacturing PMI. In particular, we're looking for the prices paid by manufacturers, because that would give us an update on the pulse of inflation. The other thing I'm watching for in tomorrow's activities. Number one, was the move sustainable from today, or was it just funny business from the portfolio redressing, propping up the NASDAQ to make themselves look a little better, and then dumping tomorrow. Is that the case or not? That's one thing I'm watching. Number two, I'm watching for the market's reaction right after the Biden press conference today announcing the massive infrastructure bill. Specifically, how would yields react now that the portfolio rebalancing is over? You have the announcement of the massive infrastructure bill, and we know that the overseas bondholders will continue to dump. So the assumption here is the yields will continue to explode higher. Anyways, these are the things I'm watching for in tomorrow's activities. That's all I got for you today, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.